right, everybody, Tuesday, June 4th. I sent out yesterday the new edition of MMT Trader. If you want to get that, go to my website, pitbulleconomics.com. Also, Zombie Trading, you can get there. That's my daily Forex signal service. We front run the zombies because we know what they're going to do. We take their money, we get out before they die. So the market was up a few hundred points early this morning, which I totally expected. The sell-off has been overdone. I think on the downside, we may have hit a 38.2% retracement. That's a Fibonacci number. I know a lot of people like to follow that. That would have been a 38.2% retracement of the S&P low on December 24th to the high, I believe it was May 2nd or maybe late April. I think that was 2960 or something like that. But we got there, or we got very close to there. I said that, well, I basically called the top in early May when I said we were going to be in for a month-long period of bank reserve rebuilding. And again, I've been all through the explanation of how that affects what the banks do. Reserves are tier 1 bank assets. And by the way, the volatility in these bank reserves, in other words, the massive flows into the banking system and the massive flows out of the banking system, this is really unprecedented. And it has to do with the debt ceiling. The debt ceiling has made it so that the Treasury cannot sell bonds, and the sale of bonds acts as a reserve drain. It's the way they manage the level of reserves in the banking system. And now that the Treasury cannot sell bonds because it's up against the debt ceiling, you have huge volatility in banking reserves, bank reserves. Because when the Treasury spends, you have hundreds of billions of dollars flowing into the banking system. It's spending every month to make its payments. And then when it collects taxes, you have hundreds of billions flowing back out of the banking system. So this flow of back and forth just creates tremendous volatility. And if you look at the Treasury's account at the Fed, its bank account basically, which you can go online and access that every day, I mean, it's been going like this, up and down and up and down and up and down. And I also explained that was the reason for the gigantic rally in the bond market. It is not predicting a recession. And I said, I am on record as this, and you could throw as many negative comments and criticisms and insults at me as you want if I turn out to be wrong and we do go into a recession. I have gone on record that this is a technical situation now related to two things. The debt ceiling, okay, where Treasury can no longer issue bonds, so there's kind of like a shortage, and the gigantic reduction in bank reserves that the Fed has engineered, right? It is shrinking its balance sheet, so it's brought down reserves, and that is sucked away all these tier 1 assets from the banks, these reserve balances, and they have to go out and buy treasuries because they must have a certain amount of tier 1 assets to meet stress tests and other regulatory requirements. So they're forced into it, and there's no supply because the debt ceiling is impeding or completely blocking the ability of the Treasury to sell. If you understand this, you know why it's going on. It is not a recession thing. Now, something happened yesterday which probably puts a lid on the bond market rally. I talked about this today in an email that I sent out. If you want that email, go to my website, pitbulleconomics.com, sign up for a 30-day free trial. By the way, all this goes beyond, this is MMT, but I take it a level beyond. This is an area of understanding that not even the top MMT people are aware of. And I can tell you that with confidence because they make statements, and I know all the top MMT people. They make statements that totally ignore this feature of what's going on right now. Anyway, so what I wanted to talk about is that market was up a couple of 100 points today. That's great. But then Powell came out and said, oh, you know, we may be open to rate cuts. I don't know if he stated it exactly like that, but that was the interpretation. So we doubled, our market's up over 400 points as of this video. Now Powell, I've said this before, I've been in this business for 40 years, since Volker. This is the worst Fed chair that I have seen since Paul Volcker. He basically trades the headlines. This is not the Fed. Okay, the Federal Reserve is a monopolist in the US dollar. It is a monopolist as a rate setter, as a price setter, by virtue of the fact that it sets rates, that establishes prices across the board. He basically trades the headlines. I mean, last year it was like, yeah, we're going to keep raising rates because, you know, we see growth. And then all of a sudden the market went into a correction and he's like, we're not raising rates anymore. And Trump was, you know, hollering at him, we're not raising rates anymore. And then everyone was saying, including Trump, you got to stop balance sheet roll-off. And then they're like, okay, we're going to stop balance sheet roll-off. By the way, the banks, and I've said this before, have been begging the Fed to bring reserve balances down. The Fed's own survey of the banks came back with the banks telling them we only need 600 billion of reserves in the system. And right now, there's what? 1.5 trillion, 1.6 trillion. So they're a trillion over, 900 billion over what the banks themselves, in response to the Fed's own survey, have been telling the Fed. But yet they're like, okay, we're going to stop this balance sheet roll-off and bringing reserve levels down. So what's the point of doing the survey? This guy's the worst. He's trading headlines. He's flip-flopping. One day they're raising rates. One day they're cutting rates. One day they're stopping. One day they're doing balance sheet roll-off. One day they're not doing balance sheet roll-off. So you cannot, I mean, you can't follow this guy. He's as unpredictable as Trump. And by the way, that's another reason for so much volatility in the market. Between Trump's tweets and his threats and his tariffs, between the debt ceiling and Powell, who just follows the headlines, trades headlines, a lot of volatility. So you have to stay focused on the big macro factors, which is what I do. And the economy's okay. Rates are going to go back up, I believe, unless the Fed cuts them. Of course, the Fed is the monopolist. They set the rate. So I can go by what I see in the data now, but they might just decide to do it. And if they do it, then rates go down, and they have been going down. And Powell follows the headlines. He follows the markets. The markets are screaming for rate cuts right now. So I don't know. You can't. This guy's hard to predict. Gold holding on a little bit to its rally yesterday, giving a little bit back. Dollar's steady. It was lower, I think, substantially lower yesterday. It's steady, maybe gaining a little bit today. Tonight we get the API oil inventories. Want to see if there's another drawdown. I think that too went a little bit too far. Exports are really, really strong. We saw drawdowns last week in the APIs. We saw a smaller drawdown in the EIA report, but I think we'll get a larger figure this week. Anyway, that's it for now. See everybody later. Bye-bye.